Hi, I'm Luis Contreras, a registered investment advisor and also a licensed insurance agent here in California. I have my life and health licenses. Um, and in this video, I'm going to talk about 4 ways that life insurance can help you pay less taxes. So let's get to it. So number 1 is the death benefit. So proceeds of life insurance in terms of the death benefit to your beneficiaries, like your heirs, pass on to them on a tax-free basis. And the great thing with that is that it doesn't increase their taxes, but in case you had, because of your death, you have any taxes that you owe that year, whether it's estate taxes or ordinary income taxes or any other taxes, for that matter, they're going to be able to use those funds to pay for those taxes. Thus, they won't have to pay as much potentially. So the death benefit is one of them. Number 2 is the cash value. So I'm talking about cash value life insurance because there's also term and cash value life insurance. So for cash value life insurance, the insurance has a cash value component to it where, those funds, you're able to access them while you're alive. You could also access the death benefit while you're alive as well for certain instances on a tax-free basis. But here, in terms of the cash value, the great thing with this is that you can leverage the cash value, meaning have access to the cash value on a tax-free basis, and thus use those proceeds for to fund your business, for other investments like in real estate and other assets, without having to. The great thing with that, the great thing about leveraging this cash value is that in case you have other investments like stocks, bonds, real estate, other businesses, instead of having to sell some of those other assets and incur a capital gain tax, instead of doing that, you can leverage the cash value in the life insurance, thus not having to pay taxes over here, and leverage the cash value to access funds, and thus reinvest those funds or do other things with them, with those funds for you to grow the money, or even use the cash value to pay taxes in case you have businesses that are not doing that well and you don't have the funds to pay the taxes that you incurred for whatever reason. You can leverage the cash value to help you do that as well. So that's number 2. So number 3. Deferral of growth. Knocking things over. So in your life insurance policy, especially cash, I'm talking about cash value life insurance policies. The growth in the cash value is tax deferred, meaning every year you're not going to pay taxes on the growth of your cash value. And if your policy is structured correctly, you also have the ability to increase your death benefit. And every year that your death benefit increases, that's also tax deferred, meaning you don't have to pay any taxes on that. Thus, when your heirs, when you die and your heirs get the death benefit, they could get all the death benefit, including the growth, on a tax-free basis. Thus, you end up with more money there. So just another way to grow your money on a tax-deferred basis in case there isn't any other way that you're doing that as well. So, and let's go to the last one, number 4. Is estate taxes. So if you have a large estate, meaning you're a very wealthy person, very rich, and what an estate means is that everything that you own, the net worth of everything that you own, so all your investments and assets minus your liability, your debt, equals your net worth. So if you have a high net worth, 50 million, 100 million or more, you're up there. You may, your heirs, once you die, like your children and other people, may have to incur estate taxes. Your spouse, right now, won't incur any estate taxes because everything passes on to your spouse tax-free. But after you and your spouse pass away, if you want to pass things on to your children, depending on the size of your estate, they may have to pay a huge amount of estate taxes. So life insurance, what very wealthy people do is that they structure life insurance in a way that it pays for this estate taxes, while at the same time decreasing their overall estate, because the death benefit actually of life insurance does get added to their estate, thus increasing their estate. But if you structure it correctly, especially with the use of irrevocable trusts, you could decrease your estate with your life insurance, and thus have the proceeds pay for your estate taxes. That way you could decrease, your heirs won't have to pay for estate taxes, and they could get all of your investments and assets that you wanted to pass on to them on a tax-free or low tax or completely tax-free basis, and whatnot. So there you have it. I hope you found this video informative, and if you know anybody that may benefit from it, go ahead and share the video, and so that they could benefit and learn more about it. And again, thank you for watching. If you like the video, like and subscribe to it. That would really greatly help me out. And yeah, I wish you all great success in your financial lives. And until the next video, you guys have a great day.